Wells Fargo's Mike Mayo sees even more upside ahead, and it's all thanks to a big tech tailwind. Mike joins us now to explain. Mike, so what's this maybe underappreciated factor that you're suggesting could help bank stocks going out into next year, let's say?
Well, you have the top line, which should show the best Main Street banking growth in over 4 decades. And with the higher interest rates and extra loan growth, that's all gravy. That's great. But what's really underappreciated is the degree that technology is having a seismic impact on profit margins. So you're likely to see profit margins on these new revenues at twice the level of existing profit margins. And in the past periods of higher rates and inflation, in the 1970s, headcount increased by 51%. Now you're looking for the best Main Street banking growth in 4 decades, and guess how much headcount should increase? Probably zero, if not down. So you're about to see the best employee productivity growth in at least 90 years. And the on-ramp to that started in the second quarter. You're likely to see more of that in the third quarter, fourth quarter, and especially next year when banks should have the best pre-tax margin growth, the third best out of 26 industries. So all this research that I and we've done over the last 4 or 5 years, talking about artificial intelligence, big data, the cloud, digital banking, electronic payments, faster processing, and the governance around all this, now it's payday. Because instead of adding paperwork and management layers and all this bureaucracy like you did in the past, a lot of these efforts are automated. So when you have new loans and new deposits and servicing your customers, you don't need to add people. So it's not just the top line from Main Street banking growth, it's the bottom line that's going to surprise people. So tech and banks, it's a beautiful marriage.
I mean, this is certainly the case for earnings leverage now more embedded in these banks' business model. But at the same time, doesn't it seem as if they've been, they're kind of forced to carry more capital than they did in prior cycles? They're not necessarily making high enough returns on it to get their valuations up too much more. I just wonder if there's offsets to this idea that they're just much more efficient than they used to be.
I mean, nothing's perfect, but our numbers have the lower deposit service costs, have the reduction in subprime loans from like 7% down to 2%, have the reduction in the higher risk loans like construction and development, have the higher capital levels. We're talking about orders of magnitude. So the higher capital levels, that can hurt earnings, equivalent by like $1 billion at Bank of America. You know how much 100 basis points helps Bank of America's net interest margin? By $10 billion, a 10 times greater benefit versus the negative impact of the higher capital, a 10 times greater benefit than if credit losses go a little higher. So all this talk about credit losses and capital, that misses the forest for the trees. The big picture here is that you have the best net interest income growth, that's 60% of the industry revenues, and I'll say it again, the best growth in 4 decades. I've said that before in the show, but now it's likely to be even higher than it was before. And the other point is that when you look at the guidance from the banks, are they looking to hire tons of people? No, they're looking to do more with less. And you've had a decade of investments in technology that finally bear fruit when the revenues come in, and the revenues are finally coming in after 4 decades in a row of declining level of revenue growth.
If it's Main Street banking that is the engine here, and that's what you're most focused on, what are the best names in terms of capitalizing on the trend?
Well, my 3 top recommendations right now are Bank of America, Bank of America, and Bank of America. I cannot believe this stock is in the mid-30s. I mean, this is ridiculous. On your show, you were talking about retracing half of the loss from the highs. I mean, you're nowhere close to that. You're trading at almost half of the market multiples price to earnings ratio. You have visibility over the next 2 quarters of an uptick of 1/4 in the run rate earnings. And guess what? Credit quality remains exceptional. Bank of America, as much as any bank, has de-risked over the last 15 years since the global financial crisis. And as you know, I testified to the Congressional Committee on the causes of the global financial crisis. And in 2007, we were on your show saying sell, sell, sell. In some ways, this feels like the reverse of 2007 in terms of the degree of the pessimism, the likelihood people are putting on a hard landing when from the micro level, things look very good for the bank. So we are certainly buyers here. I will acknowledge, though, that until we see the all clear that it's not a hard landing, that there's still some tentativeness among investors. So the consensus is buy the banks in October. I think that's getting too cute if you have a 12 to 18-month horizon.
Yeah, I was going to say, if it's so hard for you to believe that Bank of America is trading where it is, what are you hearing as to why? Is it just strictly that macro, shadow that's over the group? People aren't convinced that the consumer is going to really struggle?
Yeah, it's overly simplistic. I mean, it's the Fed's inflation is up. The Fed's raising rates. It's going to push the economy into a recession. Sell cyclicals. Banks are cyclical. Bank of America is cyclical. Just sell it. So the macro has been beating the micro. But you know what? We've been in this place for 4 or 5 months now, and the valuations of the banks are still low. And you saw it around earnings. Since earnings, banks have performed better because you saw the micro results. I mean, you see the top line accelerating. You see the profit margins getting better. You see credit quality still good. You see the de-risking benefits. And then the stocks rallied. And then you get the macro coming back and punching you in the face and saying, oh, it's going to be a hard landing this, hard landing that. I'm telling you, from a bottom-up standpoint, my 4th decade doing this bank analysis, I'm not seeing evidence from the ground floor here. It still can happen. But if you say hard landing, stocks are down 1/3. In a normal scenario, stocks up, 50 to 70%, then the weighted average returns look like they're in the investor's favor here.
Mike, thanks for coming on to make your case. Appreciate it.